Good morning.
That's the flattened version?
No, that's their version.
My name is Alex Padilla. I'm the director of the Exploring Economic Freedom Project. And today we are going to have a discussion panel on income inequality and poverty. It's the American dream in crisis. We have 4 scholars, and the moderator today is from Rocky Mountain PBS. She's an investigative journalist, and her name is Lori Jane Gliha. Let me give you a quick introduction about the Exploring Economic Freedom Project. It was created and founded in 2007. The idea of the Exploring Economic Freedom Project is to provide students and the broader community with an academic forum to discuss and debate the role of economic freedom and how it plays in improving people's welfare. We invite distinguished scholars to discuss and to learn about the role that economic and political freedom plays in promoting entrepreneurship, economic growth, prosperity, and peace. Recently, studies have shown that poverty in the US and worldwide has decreased significantly. However, it still remains a concern. And more recently, some scholars have argued that income inequality in the US has increased significantly, particularly in the last 30 years. Today, we are going to discuss and have some questions about what is income inequality, how it relates to poverty, and we are going to see if there's something we can do about it and what has been done about it. For now, we'd like to welcome our moderator, Lori Jane Gliha. Thank you.
Thank you. So again, I'm from Rocky Mountain PBS. I work on a show called Insight. It's an investigative and in-depth program. Previous to that, I worked at Al Jazeera America as a national correspondent for the news magazine program. I want to just preface this that I am not an economics expert. I'm just a show of hands, how many people in the audience are studying economics or feel pretty, okay, great. So I'm counting on all of you to think of some questions that you may want to ask. So at the end, I'm going to be calling on you guys to ask some of your questions to these wonderful people up here. Though my mother and sister both majored in economics, I chose the journalism path, which means I'm good at asking questions, listening, and learning, and I hope that we all can learn something here today as well. So first what I want to do is introduce all these lovely people up here so that you know who they are and what their expertise is. So first, Daniela Goya Toqueta is an adjunct professor of economics and program coordinator for the Center for Public Choice and Market Process at College of Charleston. Dr. Goyo Toqueta has earned a PhD in philosophy from the Federal University of Rio Grande do Sul in Brazil and has done research at the intersection between behavioral economics and experimental philosophy, studying the impact of income inequality on decision making. So if you can wave your hand, we all know who you are. Yay, we'll give her a round of applause. Next, we have Phil Magnus. He is a visiting professor of economics at Berry College. Dr. Magnus obtained his PhD in public policy with an emphasis on policy history PhD from George Mason University. His research is the field of economic history, specializing in the long 19th century United States, as well as general macroeconomics trends. He recently wrote and co-authored several papers evaluating Thomas Piketty's empirical work on wealth inequality with a specific focus on data quality. So welcome, Phil. Then we have Stephen Miller. He is an Adams Bibby Chair in Free Enterprise at the Manuel H. Johnson Center for Political Economy. He is an associate professor of economics in the Sorrell College of Business at Troy University in Troy, Alabama. He received his PhD in economics from George Mason University. He does research on a variety of topics, ranging from public opinion on economic issues to education, income inequality, and fiscal policy. He also researches and speaks on topics related to labor economics and population growth. And his most recent article, Do Piketty and Saez Misstate Income Inequality, was published earlier this year in the Review of Political Economy. So welcome, Stephen. And lastly, we have Jessemia Nelson. She is here in Denver, where she's an associate professor of sociology at MSU Denver in the Department of Sociology and Anthropology. She received her PhD in sociology from Harvard University. Her research focuses on inequality and poverty. Specifically, her work critically looks at the US poverty measure. She also does research in the field of applied sociology, an area of the discipline that uses sociological theories and methods to solve real-world problems. Dr. Nelson has taught a variety of classes in the sociology program, including Introduction to Sociology, Prejudice and Discrimination in Contemporary Society, Poverty in America, Sociology of Sexuality, Research in the Social Services, Advanced Research in the Social Sciences, and Social Statistics. Welcome. So I guess we'll start off today with a very basic question so that we can kind of understand what we're talking about here is what is economic inequality and what is income inequality? And I think I'd like to start with you, Stephen.
So I have to get the distance right with the microphone. You asked what is economic inequality, and then you asked what is income inequality. And income inequality is a type of economic inequality. When people talk about economic inequality, they're usually talking about one of three things. They're either talking about income inequality, wealth inequality, or income mobility. It's interesting. There's not a whole lot of literature on wealth mobility. There's books written about it, but there's not a lot of statistical work the way there is on economic mobility, income mobility, or income inequality. And so the difference between income and wealth is pretty obvious. Income is what you earn. It's a flow of what people are making on a monthly or annual basis. And wealth is what people have. It's a stock of wealth. And the trends are actually very different in the United States, for example. In the United States, the numbers that I trust and look at, wealth inequality has actually been very flat for several decades. But income inequality, as it's usually measured, has risen rather dramatically since the 1980s. It was flat in the early part of the 20th century and has been rising since the 1980s. And so there's a very different dynamic there. There's something going on that is a topic of hot debate in income inequality, but with wealth inequality, you just don't see nearly as much change and shift in what's been going on over the last 30 years. Economic mobility is something I think that is possibly the most important way to understand economic inequality is how easy is it for people to get ahead? How easy is it for people to make themselves better off? How much do people improve their lots over time and are able to earn more as they go on? So that's my stab at an answer of kind of ways to think about economic inequality.
Great. And go ahead, Jasemi, if you want to jump in there.
Let me know if I'm too close. Another way that is a simple way that I talk about it in terms of my students is the accumulation of income or assets in one segment of society over another. So that's a kind of a general way to think about inequality is that either the money or the wealth or whatever is valuable within society is accumulating to one segment over another segment. And so that is not spread evenly.
Okay. Daniela, I'd like for you to explain why should we care about income inequality? Why is this important?
So I come from a mixed background of economics and philosophy, so I like to think of the philosophical backgrounds of exactly the question, why should we care about it? And I like both of the descriptions that you guys gave and the approach that you introduced, the idea of looking at economic inequality in terms of differences in income, differences in wealth, but differences in social mobility, and then these differences in social mobility and how they connect to differences in opportunity. And I think when we get to that question, which relates to the topic of the American dream, right, and the land of opportunity, when we get to that question, we start to realize why we care about inequality and whether or not we ought to care about inequality. And in political philosophy, there is a great tradition of egalitarianism, and many philosophers will actually say that equality of outcomes, of economic outcomes, actually has its intrinsic value to a great extent. But there are lots of political philosophers, and I like to cite Harry Frankfurt. He has a book on inequality in which he argues that actually we don't care about inequality, we care about fairness. And to that respect, we care about is it possible, as Steve was saying, is it possible for people to move, right? Is there mobility? And I think there we can start to see when inequality can become problematic and when inequality is not problematic, because I don't think it would be the best approach to see inequality as problematic in and of itself. Usually that doesn't bother us as much. We're bothered by procedural unfairness much more than we're bothered by differences merely in outcomes.
So I'm not going to necessarily go down the line all the time, but Phil, I'm going to have you weigh in on just your perspective on this, and just if you could explain a little bit about what is the situation right now in our country when it comes to this type of inequality, and how did we get to this place? Can you describe a little bit of what went on in history to put us in where we are now?
Absolutely. So the one thing to note about inequality is it's a really tricky subject to measure. It's hard to get good statistics, especially over time, that indicate inequality. We've already gone through multiple different aspects of inequality, whether you're measuring income or wealth. Are you measuring mobility, which is really hard to get at because you actually have to track people over time to understand that. But even some of the basic calculations that we make on, say, income inequality or wealth inequality, the mathematics behind it are both complex, and the data that we have going into it are not all that great. So one of the issues that comes up is most countries in the world really don't have good data going back more than a couple decades. The United States is kind of an exception to that. We have semi-decent data going back to the early 20th century, so right around the start of the income tax in 1913. But you can go back in the economic literature. There's a great little article by Milton Friedman, a famous economist, later wins the Nobel Prize, that he wrote in 1939, and he was asked to comment on a series of papers that were trying to estimate income inequality as it existed in the 1930s, at the end of the Great Depression. And he went through and he said, okay, these are interesting methodologies. What do you do to measure income inequality? Well, they were looking at income tax returns. They were looking at surveys where they asked people basically how much do you make, how much do you report as your own net worth effectively. And he goes through and he says there are all these different problems that we have when we try to measure this. First thing, if we look to the tax data, well, people cheat on their taxes. They lie on their taxes. Also, taxes have all these exemptions and deductions that are built in that distort the actual statistical picture that we get. Second thing, if we ask people in surveys, they're not always forthright. So the same problem that existed in 1939 for measuring inequality still kind of plagues us today in a lot of the data series that we have. To give you a short answer of what's gone over the last century, there are two kind of competing theories. One is the Piketty-Sayes theory. It basically says that inequality has followed a U-shaped pattern. It started really high around 1913, the beginning of the income tax era, stayed high through the Great Depression, drops off during World War II, flattens out at the mid-century, and then since about 1980 onward, it's kind of been up on the upswing. So that's their narrative. It's built into some of their data. The alternative narrative, and this comes closer to my own work, closer to my own theory, is it's been much more flat and stable over the course of the century. So you do have minor fluctuations from time to time, but they tend to correspond with changes in the tax regime, changes in the way that income taxes are assessed and collected. And you have a much more flat trend, especially if you're getting on wealth inequality. I think Steve mentioned, if you look in the past 30 years, out of about 4 major metrics that you use to track wealth inequality in the last 30 years, 3 of them are pretty much flat to maybe a slight increase, and only one of them showing the sharp increase.
Jasemia, oh, go ahead. Did you want to tag along? Because then I have a
did.
question for you as well.
Yeah, I wanted to go back to the question, which is why should we care? I think there's a lot of data out there that people kind of intuitively know this, but there's actually data to back it up, that inequality is not just about feeling like you don't have a Ferrari or something like that, feeling bad about that there are actual real consequences for people's outcomes in very basic ways. So one recent MIT study that was published in 2016 found that the richest 1% of men live 14.6 years longer on average than the poorest 1% of men. And then you see similar differences with women as well, and that over the last 15 years, because people are very concerned about inequality as it's been growing over the last generation or so, life expectancy has increased for men about 2.34 years, who are among the top 5% of earners, but has increased by about 0.32 years for men that are at the lowest 5% of income earners. So just in terms of life expectancy, in kind of a very rough estimate, people that are wealthier live longer. And you see this in study after study, and it's pretty clear as you separate the quintiles or however you separate the distribution. As you go up, people are living longer and they tend to live healthier. So on a very kind of basic level, inequality seems to be related to how long people live and how healthy they live. So that's one of the reasons people, I think, say it matters.
Okay, Daniela, you've got something you want to say about that. Go ahead.
Yes, because I think that's a really good point. And I think that relates to the idea of it's not that we care about inequality in and of itself, regardless of its consequences. And then when we look at the philosophical arguments of it, you think, okay, under a consequentialist view, right, what comes about when we have really high levels of economic inequality? And what you're saying is exactly what we have been finding, that we actually have detrimental effects of at least extreme levels of economic inequality, and we can discuss what those actually are, because that's an empirical question, and it depends whether you will evaluate as extreme or not. But I do think that and it's interesting that Thomas Scanlon, a philosopher at Harvard, he says that we have to worry about the fact that inequality may undermine the conditions of its own legitimacy. Because while inequality can be legitimate, and mostly we don't want an equal world, extreme inequality can undermine the fairness and the justice that allows people to move throughout different quintiles in society. And then you have also Harvard economist Raj Chetty, who has research on economic mobility and has found results such as for kids that are born in households with an annual income below $25,000, if they are born in Atlanta, they have a 4% chance of moving to the top quintile of the income distribution. If they are born in Iowa, they have an 18% chance. And to say that talent is not evenly spread around the country doesn't even make sense. It's opportunity that's not evenly spread. And that's not to say, like, okay, so we don't want inequality, let's equalize everything. That's to say, like, let's see what the empirical effects of extreme levels are and try to see how we can better address that. So I just thought that would
And
nice.
my follow-up, Jasemia, to you just is, we touched on what is the difference between inequality and poverty? And if you can describe how inequality affects poverty and whether or not inequality is a threat to poverty, reducing poverty.
That's a lot. So there's several different definitions of poverty, and it depends on how you decide you want your measure. So there are absolute, or we might think of as objective measures of poverty, which are related to some subsistence level that you need to live, okay? And then there are relative measures of poverty that are really focused on economic marginalization. So to what extent can you take part in the life of your society, okay? So obviously, absolute poverty is really easy to understand, which is if people don't have enough to eat and they're in the midst of a famine, as there actually is happening in the world right now, we would say that they're poor and nobody would really argue with that. Typically in the US, those are not the kinds of problems that we have en masse. However, many people have argued that if you're in a society where, yes, you have enough to actually live, perhaps you're living in a tent, you have enough to eat, but you can't take part in the you can't take part in work, you can't take part in the socialization or the socializing, you can't take part in community, that you're poor as well. So a good example would be in a society where everybody has the internet and life is organized around having access to the internet. If you don't have that access, you can't apply for jobs, you can't communicate with people, you can't enter the clubs, and et cetera, et cetera. And so typically you have one or the other leaning in terms of how you measure poverty or what kind of poverty you have. In the developed world, typically poverty is always somewhat relative, because what research has found is that as living standards increase, what people think you need to get by also increases, okay? So we can look at Denver, for example. How much does it cost to live in Denver? Well, we know that Denver's getting more expensive, and so what the answer to that probably was very different 20 years ago than it is today. And so I think poverty has both those kind of components, both relative and absolute. Income inequality affects the relative measure. So for example, in the EU, they use typically 60% of median income as the measure. So as income inequality increases, the idea is that if you have more people that are left at the bottom end, then poverty would also increase, even if nobody's kind of dying of starvation or anything like that. That was one question. What were they?
Well, yeah, and I had also asked whether inequality is a threat to reducing poverty.
Absolutely. I would say it absolutely is a threat, depending on how that becomes spread, right? What many people find is in the days of the war on poverty in the 1960s, the basic policy was we just need to have economic growth. And you actually see that repeated by politicians over and over. We don't have to worry about income inequality. We just have to worry about growth. If we can just get growth on track, then we'll lift people out of poverty. And that's fine in as much as the growth is evenly spread or spread to a certain sector. However, if the growth is accumulating to the people at the very top, you're not going to do anything to poverty in a society that's becoming more unequal. So you may actually get more poverty even when you have a society that's very wealthy like the United States.
Stephen, if you could weigh in on that, I'm curious what your thoughts are based on what Semia just said, and then also what policies seem to be working in your view to help reduce income inequality here?
So I'm tempted to say that I agree pretty much with the answer. That's what's needed is more growth. However, along the way, if there are institutional barriers to mobility, that's the key, is removing institutional barriers to mobility. The numbers that Daniela gave, Atlanta versus Iowa, that tells you something. There's something going on institutionally in terms of barriers to income mobility and economic mobility in those two different parts of the country. So that is an important thing to keep in mind. The interesting thing, though, is that when economists have studied and looked at data, actually the same data source that Piketty and Says use, and they longitudinally look at individuals over time. So, for example, they will, by tax ID number, actually look at people over time, over the period of 20 years. So one famous study was from 1985 to 2005, following the same people. And it found that in terms of mobility, the people in the lowest parts of the income distribution are the ones who actually gain the most in seeing their incomes rise over that 20-year period as individuals. So although the income distribution, when you're looking at a snapshot of the bottom 20% is here, and the top 20% is here, or the top 1% is here, and the bottom 5% are there, you have to understand that that's static and it doesn't take mobility into account. It doesn't track the same people. People move from one quantile to another. They're able to move out of the bottom 5%, and people fall out of the top 1%. They do so all the time. Actually, 60% of people in the top 1% fall out within 5 years. It's not a stable group of people when we talk about the top 1% or when we talk about the bottom 20%. So that's very important to understand. The question is, really, are people made better off? And so when you track individuals, it looks like actually there's a significant amount of mobility. There's higher mobility in other countries. It certainly could be better because I think there are institutional barriers to income mobility. The other thing that this brings to mind is the question of how individuals fare in other countries. And so that's something I'd like to get to at some point, but I think I'll
I think we will get to that, but what I'd like for you to do too is just, you've mentioned institutional barriers a few times. What do you mean by an institutional barrier? And maybe some other people may want to weigh in on that as well.
Yeah, so I think a great example is occupational licensing. I think in some states it's out of control. What happens is there are occupations where not only do you need maybe a certain number of credit hours, but there's a certain amount of testing required. There are expensive fees and expensive licenses to pay for, expensive continuing education credits, and that keeps people out of the job. Now, look, if we're talking about surgeons, I kind of want to know that the person operating on me has been to school for 15 years and is an absolute expert. right? And I also like to know that they make a lot of money. I mean, that's another piece of the inequality puzzle, right? I don't want a doctor who makes $30,000 a year. I want one who is really well paid and very well regarded in the profession. So that's occupational licensing is a great example. I mean, when we have occupational licensing required for hair braiders, for garbage collectors, and for a variety of occupations, and it varies so much from state to state. It's rather amazing that there's. I think the statistic is there's only like 3 occupations that are universally licensed across all 50 states, and then everything else is it's a state by state, whether florists are required to have a special license and have, hundreds of hours of education.
Phil, what do you think are some of the institutional barriers, and how do you think we can overcome some of those? I don't know if you have suggestions on what might work to overcome some of those things.
I can actually jump in with one prominent historical example of an institutional barrier, and we saw it in the United States, segregation.
Yeah.
And we see it even more pronounced cases elsewhere in the world, such as the famous example is South Africa's apartheid regime. And what basically happened in those historical examples is you had the force of law brought down upon people of certain races, certain segments of society, and it's basically telling them you cannot work in this sector of the workforce. You cannot ply your trade in this part of the economy. You cannot engage in this type of activity. That in itself is like an extreme, rigid form of social inequality that's enforced by institutional mechanisms and barriers. And what they found is that, when apartheid went away, you start getting people moving. So you had black South Africans that were moving into sectors that for 80 or 90 years had been the protected legal domain where only white people could work in. So you get this extreme scenario of discrimination enforced by the cover of law in really horrible ways. May actually be one of the great stories of inequality in the 20th century, is regimes where this type of thing is in place, and then seeing it go away, seeing it being chipped away, whether it's overturned by, say, like a Supreme Court decision, as happened in the United States, whether it's overturned by a change in attitudes over time that move toward greater acceptance of racial equality. So if you go from the historical perspective, I guess what I'm trying to get at is this is probably the most pronounced example of a change in institutional barriers that we've seen in recent to relatively recent history. So I say let's ask the questions: what lessons can we learn from that? What lessons can we learn from the fight against segregation or the fight against apartheid abroad that basically undermine these types of regimes that allow people just to simply pursue their lives as they want to live them, work in the professions that they want to live? That in itself becomes an equalizing pattern.
I feel like at this table there's some jumping
Yeah.
in that wants to happen. Go ahead, Stephen.
Well, I just want to add on really quick to that. And there's a very ironic thing here, is because right when the data series that everybody uses, that we use, that we study, show an absolute low point of inequality, right, where the U.S. economy was supposedly most equal, is right when you had Jim Crow and enforced segregation in the U.S. So that strikes me as there's something missing in the data if it doesn't capture a very important, very obvious to the eye sort of inequality that was going on.
Did anyone else want to add on to that before
I just echo that. This is why I'm very hesitant to view something like the mid-20th century as the supposed golden age of equality. And if you look at some of these charts, if you look strictly at the data, they show the bottom of the U-curve is like 1950 to 1960. That's a problem for me. That's not matching up with reality of what I know from the historical events that are happening at that time. So that tells me, exactly what Steve's saying. There is an issue with the data quality. We are missing something that we're not capturing in that set, or maybe it's biased or distorted by what it is actually measuring.
I'm just curious, is there a better way to gather data? Like, what would you advise, any of you? How would you gather data if you could gather the data that would help determine what we need, I guess?
Yeah, there's something, if you want to give any of us a Nobel Prize at this table, we can figure out that problem. Something that people have been trying for 100 years to get right. How do you measure inequality? I can go over probably about the 3 main ways that I go through real briefly. First one is you use income tax data. You look at tax returns and extrapolate from the way that taxes are collected. You can figure out who pays what roughly. You can figure out the distribution from that. Problem, tax rates change very dramatically over time. We don't have very stable tax regimes for more than maybe a decade in the entire existence of the income tax in the United States. And sometimes these rates, the fluctuations in rates are dramatic. Like between 1931 and 1932, I think it was, the top marginal rate jumped from 25% to over 60% in a single year. And that's one of the extreme fluctuations, but there are other examples of that throughout history. Every time you do that, it changes the way that people report their income, the way that they report their taxes. So how do you measure that? That's the endemic problem there. Second way you could calculate it, look at estate taxes. Because you actually have estate returns when people die. They file their estate paperwork, and it's measured up to see how much wealth, how many assets they had. And you can extrapolate from that, going by the mortality rate in society, and figure out, roughly how many people are dying in a given year, and what percentage of them are the wealthiest 1%, the wealthiest 10%, and how big are those estates. I think that's probably my preferred way of going at it. I think it's probably the strongest of the three in terms of getting like a century-long data picture. Because you can't really stop people from dying. You can't really stop estates from being tabulated. And it's a little harder, although there are some ways to get around things like estate taxes, but it's a little harder to manipulate that in response to the tax rate as opposed to income taxes. So that's the second way. Third way, you run a survey. You ask people. Ask people how much they have. Some people answer in very interesting ways. I'll give you an anecdote from one of the more popular kind of semi-surveys is the Forbes list, the Forbes billionaire list. And some people have tried to incorporate this into a measure of inequality. We see how rich the richest people in the United States are based on their self-reported net worth. Back in the 1990s, there was a problem that emerged in this that statisticians discovered. It was actually named at the time the Donald Trump problem. Had absolutely nothing to do with current political situations, but it came down to the way that Donald Trump was self-reporting his wealth and assets in New York City versus what they were showing up on the tax returns. And people started looking at this and found a distortion in the Forbes list where they couldn't reconcile the two. And I don't want to pick on one person, but this is endemic. This is a status thing for multi-billionaires, is how they report, how they self-report their data. Now, you could go other ways of administering a more formal survey, but it's always really tricky to get at that ultra top end, the top tail of the distribution. That's where the accuracy problems come into play. So there have been attempts by the Federal Reserve. They run a periodic survey that tries to get at this, but it always has some sort of adjustment that you have to make that's involved in it. And they've gotten better than they used to be at capturing that very top, ultra rich segment of society. But still, it's just such an uncertainty that's built in there, an uncertainty in the way that people self-report, that this is the gist of the problem with inequality. It's almost impossible to measure accurately and reliably.
And I think Giuseppe and Daniela both want to jump in here. So go ahead, if you want to go in order, that would be fine.
Sure, and I was going to say that, so research has found that actually calculating income by self-reports is not easy either for the high end or the very low end. Yeah. So on both ends of the distribution, collecting data is tricky, and not just because people, like billionaires, don't want to say they're richer than they are or don't want to say that they made this much money. Part of it is that, for example, people who get irregular incomes, recall might be difficult. And if you're asking somebody their gross income, well, I don't know what I got gross, especially from month to month. I might know what I have this month to spend. Mm-hmm. I know my kind of disposable income. And so it actually turns out to be a problem all throughout the distribution. For full-time, year-round workers, they tend to most accurately reflect what they make because it's really easy. They know what they make every month. They know what that adds up to. And so data for them is really easy. But for the very low and the very high end, that's the trickier part.
Daniela, go ahead.
So I just wanted to add something that relates with the former point that we were talking about. So we started talking about why do we care about it, right? And why does it mean, what does it mean to talk about economic income, wealth, socioeconomic mobility, inequality? I think the issue of measurement, which is great that everybody is worried and talking about because it's one of the greatest issues, and it's a deeper issue too, because what we measure not only reflects what we care about, but it determines what we care about. If we measure income, it means that that's how we are defining what a good life is. And if we measure income and we only look at that indicator, it means that policies will target that indicator. And when that thing goes up, we'll say that policy was successful. And when that thing goes down, that policy was a failure. And many times we overlook the relevance of that and the impact that it has in long-run policies and short-run as well. So the question is, even if we even if we tackle the measurement of income inequality, so you guys get the Nobel Prize. And we got it. We figured it out. I mean, I didn't. You figured it out. And then we achieve what we take to be somewhat reasonable levels of inequality. They can be high, but everyone is fine, and then it's all good. When we look at how people are living their lives, are we then able to say that we no longer experience socioeconomic inequality? Is that all that it was? And that's what I wanted to question. And I think when we look at the face of income inequality in different countries around the world, and I think Steve would like to talk about that as well, you can see that it looks very different. And that difference in how inequality looks in different places, it brings back this awareness of, okay, it looks different. And can we say that because in that place it looks like people are not actually really poor, can you say that they're actually okay? Can we not say? And I'll let Steve talk more about that, and then I'll...
Go ahead.
I'll
Maybe
add to
Stephen,
it.
if you want to talk about are rich countries more unequal than poor countries?
And that's a tricky thing. And so that was exactly the question I was trying to answer a couple of years ago. And then within the last year, I've started working on editing a book. My colleague, G.P. Manish, is from southern India. And he came to me one day and he said, I know you do this work on inequality. I want to talk to you about it. And I said, okay, let's talk about it. He does macroeconomics and economic development work. And he said, there's something wrong with how inequality is measured. And I'm working with the data the way Phil and others are. And I said, yeah, no kidding. No kidding, there's something wrong with the data. He goes, no, you do the American data. He said, the American data is really, really good by comparison. I'm talking about the international data. I'm talking about the global data. And so usually when inequality is compared across countries, and someone is trying to answer that question of are richer countries more unequal or less unequal than poorer countries, he said they use Gini coefficients. And a Gini coefficient simply is a way of measuring how spread out the income distribution is, not even how big the gap is necessarily between the richest and poorest, but how spread out income is over the economy. And the more unequal it is, the higher the Gini coefficient. And the closer it is to perfect equality, the lower the Gini coefficient. So a Gini coefficient of 0 would be if everyone in the country earned exactly the same income. Okay? And he says, so India has a lower Gini coefficient than the United States, significantly lower. And I said, yeah, I can see that, makes sense. He goes, well, it doesn't seem to be the type of inequality that I or most people would care about. And I said, well, what do you mean? He said, well, if you hire a plumber in the US or you hire a carpenter, they show up at your house and they're driving a car or usually a pickup truck or something, and they bring in their materials and they do the work and they go home, and it's actually, once you have met them and know them, it's quite likely you realize your kids go to the same school, or it's quite likely that you realize that you shop at the same grocery store, or you'll see them when you're out to eat for a date night with your wife, right? You'll run into them and you realize they're part of the same community you are. And they're someone that you see, maybe not on a daily basis, but on a regular basis. They're part of your life. And he said in India, if you hire a carpenter or a plumber or something, or someone in the service sector, it's a very different thing. First of all, they don't arrive in a truck. They arrive on a bicycle or on foot, right? They're dressed very differently, and this is someone you never interact with. I mean, he's from southern India, so it is different in as you go north and in the cities. But it's very, very different, the experience. He says the inequality is so tangible and obvious and visible. And so I got the bright idea, and we were doing Google image searches last night when we were talking. And if you do a Google image search of, you can do it now if you want. If you do a Google image search of India inequality, what you get are very stark photographs, tons of photographs, photograph after photograph. And a lot of them are photographs that have skyscrapers and slums, right? And if you Google Brazil inequality, you get similar photos, skyscrapers and slums. Or Danielle found a really neat picture of like these condos where each little bitty condo had its own individual pool adjacent to slums with this wall kind of to separate, right? And that there's this gap between people. Well, what happens if you do the Google image search on US inequality? You get a bunch of charts and graphs and charts and graphs. And you have to scroll quite a ways just to find a picture, a photograph. If you scroll enough, you start seeing, like here and there, a cartoon about inequality, right? But mostly it's charts and charts and graphs. And if you Google Europe inequality, same thing as the US, charts and graphs, charts and graphs. Of course there's inequality in the US, of course there's inequality in the EU, right? But you don't see it in the same way that you see it in developing countries. The strange thing about this, the reason I was doing Brazil as well as India, with the US and EU countries in the middle, was because Brazil has one of the highest, possibly the highest of all measured countries, the highest Gini coefficient. It's the most unequal country, according to this, and the US is somewhere in the middle, and India is well below the US. So Brazil is less equal than the US, and India is more equal than the US according to these numbers, but the photos looked so much more similar. I mean, they're different countries. I mean, Brazil certainly does have higher incomes on average, but the inequality, the picture of it, and the way it looked, and the gap between people in their lives, the distance, looked very similar to me.
What does that mean to you, though? I guess when you saw that, what does that mean? What do you make of that there is such a disparity between countries and how we talk about inequality?
So one thing may be that, Phil mentioned, compared to other countries, the US and EU countries, they're going to have a lot more data and have higher quality data. So maybe maybe that worked out that way just because people prefer to make their case with data. I have a hunch that's not what it is. I have a hunch that it's something about the visibility and tangibility of it. So when I scrolled down really far for the US after all these charts and graphs and charts and graphs, and I did find photos, initially I could only find a photo of two people. So it would be like a photo of the steps of a building in Manhattan, right? And a guy in a business suit walking by a homeless person on the steps, right? So it's a photo of two people, not a photo of thousands or hundreds of thousands of people and how they live, and juxtaposing that. And then I scrolled, and then I couldn't find many, but when I could find photos where there were multiple people, more than just two, what it was one homeless person in a city, and then lots of tourists and people going to work and all of that. And what's remarkable to me about that is if you can imagine one of these images, like a bunch of people standing around at a bus stop or whatever, or people walking down the sidewalk, right, maybe in Denver, is that it's actually, when you think about it, it's very hard. When you think about all the action in the top 1% and all the discussion of income inequality and wealth inequality in the US, it's very hard to point to people in that photo and really know who has the highest net worth or whose income is the highest. It's not as easy. First of all, I would suggest it's not as easy as you think, right? The person driving the flashy car, for example, may not make more money than the person driving the 7-year-old Buick. Right? It's harder to tell in the U.S. that there's a lot of inequality of consumption, but that's not the same as inequality of income or wealth.
Go ahead, Jessamia.
And I would say that. And I would also say that part of the reason, because I like you, when I've traveled in developing countries, I'm struck by how much plenty and kind of economic marginalization right next to each other. But somehow in the US, I think we've organized ourselves, particularly high-income individuals have organized themselves in such a way where they never have to see it. We've organized our communities that way, we've organized our schools that way, so that if you are one of these high-income or high-net-worth individuals, you could spend your whole life never having to interact with anybody that you're not paying for their services, right? So you may have a nanny, you may have people that come and work in your home, but you don't know how they live because they don't live near you. They have to drive in pretty far. They don't go to your schools. People are, even if you go to public school, people tend to, the way we've organized our neighborhoods they don't tend to be mixed income neighborhoods. And so I do think that there's more invisibility to the fact that there is inequality, certainly not to the level as in developing countries, I would say, not at all, not anecdotally from what I've seen, but that there is this invisibility to it because different strata kind of wall themselves off in all these different aspects of life, so they never have to interact or see. Whereas in other places, you'll see a really beautiful house, and then you'll see, like you said, a slum right next to it. And so there's a different visibility to it in other countries.
Daniela.
I think both of you made really good points, and the difference is like, it's indescribable. Like either you see it or I'm from Brazil, so I was raised like that, and I mean I was raised being faced with that since I was young, and it's amazing how once like you get used to it, because you just see it every day, and that's how kind of life works, even if it's completely absurd. But it's interesting because when I moved to other countries and when I traveled to developed countries, I would go to areas, and we were talking about that yesterday, I would go to areas in which people would say like, oh, this is like poor and it's dangerous. And I would look around and be like, doesn't look poor at all. Like I would live there. Like I would think to myself, it looks pretty okay. Because I was used to such striking deprivation that doesn't look poor. And then what's interesting is that as I adjusted my lenses to look at poverty in developed countries, I started seeing it more accurately. So it's not that there is no poverty there. It's a different nature of poverty. And of course, it should have been obvious to me. But it takes a while because I'm used to it being so striking. I'm used to like a 5-year-old carrying around a 2-month-old in the street asking for money. That's what I'm used to. And you don't see that in the US. So when you look at like a project, it's like, okay, it looks bad, but it doesn't look that bad. But then when you start thinking about it, you realize there's a different nature to the poverty. And it's a poverty with stuff, which comes back to the idea of to which extent are we able to claim that we have enabled everyone to pursue a meaningful, good life if we make sure that everyone has access to cell phone, internet, TV, and a tent, right? So to which extent we can claim that? And of course, is it better that you're not hungry and that you have access to lots of things? Like, I don't want to dismiss the benefits that economic growth has brought, because I think they're overwhelming. And it's very important that they're not dismissed, because I do think that many times in the debate we start getting like, okay, but it's bad, no, it's good. It's like, no, wait a minute, it's more like here. So I don't want to dismiss, but it's also interesting to try to address, and it also connects to the point of poverty being relative and having all these aspects that many times we don't talk about, and that will affect our health outcomes, will affect our levels of stress. Richard Wilkinson, who is a British epidemiologist, he has a lot of research on the effects that inequality has on health outcomes. And what's interesting about his research is that many of the significant effects are on the richest people, related with stress and health outcomes. So we, just to point out, there are all these things that sometimes are hidden when you don't really see it.
Phil, I don't know if you want to take this question, but is economic inequality or income inequality ever a good thing? Can it be helpful for growth? When is it good?
Yeah, so we do want an incentive to better ourselves. I mean, everyone wants to be rich. I think if I polled the entire room here and said, would you like to win the lotto tomorrow? You'd be insane not to raise your hand. So that would be like a luck example of stumbling into wealth. But the very notion that we view, part of the American dream, whether we want to call it that or just economic activity in general, that we view our lives as aspiring to something better. Well, one of the draws to aspire to something better is the chance to become wealthy or become better off than maybe the previous generation was, better off than our parents were. So there is an actual incentive that's kind of built into the notion of how people look at wealth. People tend to want to get into a better situation. If we had complete equality across society and everyone made the exact same dollar amount, this is an extreme example, but if we use that as our point of comparison, what do? You take away that incentive. You take away the mechanism that inspires people to do better than the previous generation, or do better than their parents, do better than their current lot in life. So I do see that as a necessary mechanism of driving economic activity. You need to have some sort of aspirational thing to go after, some wealth to go after.
Why don't we go down the line?
Yeah.
Go ahead, Daniela.
I couldn't agree more. The matter of incentives is very relevant, and it's something that sometimes is salient in philosophical discussions without economic background. The idea that you can actually organize society in the absence of good incentives, I think they're crucial. So we don't want inequality. We don't want pure equality. But it's also interesting to see how, in addition to the idea of incentives, we also many times don't think it's fair if everyone gets the same thing, right? And you see that in other primates, not only humans, and you see that in children. And you see that they're bothered when they do the same thing and they have differential payments. They're like, I did the same exact thing, therefore I get the same thing that he got or that she got, right? And if it's like, no, but I did like, mine is so much better, or like, mine is crap, right? Like, she actually should get more because hers better, right? So we also we have this feeling of this idea of rewards matching our merit, and we care about that. And there's a lot of research showing that. So not only you have a matter of incentives, but you have a matter of procedural justice that is so ingrained in our psychology that could we argue that we ought to extricate it from ourselves? Sure, but good luck. It'll be really hard. Yeah.
Jasemiah.
So I've had this sort of conversation with Europeans that I've come across, and they put me on the spot and asked me to defend why Americans do certain things. But recently I was at a party, and this woman is from the Netherlands, and she said, in the Netherlands and a lot of Western European countries have much more, a much bigger welfare state, right? They have a lot more benefits to average middle class people, not incomes tested just for people that are poor. And she said, what is up with you Americans always wanting to be billionaires? It's like, why can't it be enough to have like a good standard of living and have a good education? Why do you guys have to want so much? I've also been asked, why do we need to give tips? Why can't you just pay people better? And I literally was like, I cannot defend this whole system. I cannot be the token American here defending this whole system. But that's, the question becomes also, it's a question of values, right? So I think the question of income inequality is how much is acceptable? And I think that's really what people are discussing. And how much is unfair, unjust? And I think the discussion is really focusing on if you've earned it, if it's merit-based, most people would say, yeah, that's fine. I know somebody that worked a lot really hard, they're really talented, they should get, I don't have a problem with Steve Jobs being a billionaire, or when he was around. He was talented, he gave us something, he made lives better. But the question is, how much is too much? When you have people who were born into wealth and get a trust fund, is that fair? Did they earn it? And I think that's really the question, is how much inequality is acceptable and how much has nothing to do with merit, but has to do with the luck of where you ended up being born.
Did you have anything you wanted to add on to that? Because I have another question, if not, that pertains to this. No, go ahead. I didn't mean that was the.
Seem to have been covered on that question.
Okay,
I
so
have something to add exactly to that, but
go for it. Jump in. That's fine.
Is it okay?
Yeah.
No, I just wanted to add to this discussion regarding merit and luck, and the cultural differences between all societies, if you think about it, right? We don't share the same values completely, like there are lots of overlaps. You can see many cultures going through a process of Americanization, you could argue. Like, I see it in Brazil, it's amazing, like how it happens. But there's definitely this difference in value of, and Americans are, I think humans to a great extent, not only Americans, tend to care about merit. Americans tend to really care about merit and effort, right, and those kinds of issues. And Americans tend to really care about choice and personal responsibility. So there is I can't remember her name now, I apologize, but there's a researcher in California, and she does research on the value of choice. And she tells this anecdote which illustrates perfectly the value of that Americans put on choice. She talks about, I don't know if everyone already heard it, when she was on a trip in Japan, and she ordered green tea. Does anyone know this story? And she asked for, can I please have a cup of green tea with sugar? And the cashier looked at her, we don't put sugar in green tea. And then she said, like, okay, I understand, but I would like a cup of green tea with sugar, please. No, we don't drink sugar with green tea. And then she said, no, okay, I understand you don't do this in Japan, but I would like just my cup of green tea with sugar, please. And then the cashier said, just wait a minute, I'm going to call the manager. And then she went in the back, asked for the manager. And the manager came back and said, we're really sorry, but we don't have sugar. And then she said, okay, so I'll just have a coffee. And then she sat on the table to drink the coffee. The sugar was right on the table. And she realized that one, they didn't value it as much. The other thing is that they were trying to protect her. Like, you don't know what you're doing. You don't drink tea with sugar, right? And they don't put the same value that, to a great extent, we put in choice, right, in personal choice and responsibility. So we see these differences, and they will reflect in all different areas of life. But still, we do want to reward people, as you said. And many times, I did some research on the difference between how much we want to reward people based on their effort and based on luck. And it was actually interesting to find that we want to reward people many times based on luck, as long as it's natural, which is really interesting, because if you think about it, so this person was born with like this striking talent for math, right? So I think you were able to calculate these crazy things when you were like 3 years old. You were born with that. We don't say like, oh yeah, you worked hard for it. You were born with that, right? But we're fascinated by it. And when asked, people want like that kid and that person to thrive and have high rewards. But we are really bothered by the social luck. So it's like you were born in a slum, and that is kind of unlucky, right? Or in a family that maybe was abusive. And then people are bothered by that inequality, which is interesting. And not only we do want to reward effort, but there's even some types of luck that we do want to reward. So we really have this merit differential idea. So I just wanted to add that point.
And the question of merit versus luck is why mobility is so important, right? If mobility is higher, then people who have bad luck have a chance to get out of it. People with high merit have an ability to move out of their situation, even if merit was combined with bad luck. An example is in the U.S., 9 out of 10 millionaires have inherited nothing. Why is that? Well, because last generation's millionaires, they may well leave inheritances, they usually do, right? But it turns out if someone doesn't have the right habits and the right mentality and if the merit is not there, it's very easy to lose money. I'm not sure if anyone else here knows that, but I've experienced that some in my life. It's actually very, very easy to just waste and lose money. And that's something to keep in mind. But the more mobility is not just about people moving up. Mobility also means that people move out of the top. People who make bad decisions or are wasteful suffer the consequences.
Go ahead, Jasemia.
And just on the mobility issue, we have, I think, a disconnect between what the data suggests and what actually happens. Americans believe there's this wild amount of mobility that we have, and so inequality doesn't matter because you can move. It doesn't matter. Wherever you started, you can go to the very top. And we put up these examples, but they're usually the exception that prove the rule, which is that actually there's not as much mobility in the US as people perceive. And that we actually have less mobility than lots of other Western European countries that have, similar type of economies that we have. And so we tend to associate kind of that stickiness of situation with Europe and the aristocracy and all that. But we actually tend to have more stickiness in terms of place. And that actually, I think, of the big European countries, I think only the UK has less mobility than the US. And the other countries have a lot more mobility. And so I think part of that is perception problems, is that the data suggests one thing, but the reality is something else. And so when people say, well, you shouldn't worry about where you started off, you can go anywhere. One stat I found was that only 6% of children born to the bottom quintile made it to the top. That's not the level of mobility that everybody tells you there is in the US. Is there mobility? Yes. And it typically is smaller steps. It's not the big leaps that people tell you can do, so don't worry about inequality. So I think that's one of the other responses to inequality is we wouldn't worry about it if mobility was really easy, but it's not as easy as people perceive.
And it's smaller steps.
Smaller steps.
Because 6% make it from the bottom quintile to the top in their lives, but 60% make it out of the bottom quintile during their lives. And 60% of people in the top quintile fall out of the top quintile in their lives.
But they might be just below.
Right. And that's what it is it's
A little bit, yeah.
So while we were talking about merit and luck, and I wanted to bring up this example because we at Rocky Mountain PBS recently did a piece related to University of Denver. I don't know if you've read a little bit about this story, but it talks about wage inequality and gender inequality. And there's a EEOC federal lawsuit that was filed against that university when a bunch of female law professors discovered that they were making thousands of dollars less than their male counterparts for the same exact job. So I guess I'm interested in knowing, and we can go down the line if you'd like, or whoever wants to jump in on this, but how does this type of inequality play into our economic success or failure or growth? Describe how this makes an impact, and maybe we start with you, Phil.
I can jump in here and well, this is a little, gender issues are a little bit outside of my main research area, but I will say that I tend to be of the belief that sunshine's the best disinfectant. If we have good statistics, we have good data for points of comparison, that allows us to actually make that comparison. That allows us to notice when there's a disparity that emerges. It also means that there's economic opportunity to close that disparity.
Jasemia, did you want to weigh in on that?
I just
Oh,
wanted-
sorry,
Daniela.
Daniela, sorry.
No, because that's not my area at all either. But I get to say it because I'm a woman, right? No, I just wanted to weigh in a little bit on the behavioral aspects of gender inequality, because I do agree that data and transparency will go a long way and will be immensely helpful in leveling out the playing field, right? But to some extent, we have to also be aware of our own behavioral heuristics and biases when it comes to decision making and when it comes to the bargaining process, when people are hired, when it comes to interviewing and these sorts of things that many times get overlooked. So there is research on how behavioral economics can actually help to create processes that will at least to some extent drive out the gender inequality and the pay inequality. And the idea is to try to unbiased interviews, because there is research showing that if you emphasize characteristics such as leadership for women, it is perceived as bossy, while for men it's a quality. And it's not like people are doing it because they're ill-intended. It's because sometimes it's kind of part of our culture. And we automatically respond like that, but that means that it negatively affects women that are leaders, right? While it benefits men that are leaders. And then you have those types of biases. Women are less likely to negotiate for higher salaries during interviewing processes. So if you are going through an interview, ask for the higher salary, because women don't. Women go for a lower salary. And once again, sort of a natural thing that we do, but it ends up creating those, helping, at least marginally helping, to create those differences. So I just wanted to bring about that input.
Yeah, I think when it comes down to the kind of the gender pay gap or gender inequality, I think what everybody's saying is that there's a lot of things that play into it. There isn't one thing that we can fix that it'll poof disappear. There are lots of things that go into that. I want to point out another factor that hasn't been mentioned, which is what goes on in the home and in relationships actually has a lot of impact in terms of the economic sphere and the economic fortunes of women. So we tend to focus on the workplace and how people get paid, et cetera. But I don't think a lot of, or some of it is blatant discrimination. A lot of it has to do with, for example, women are more likely to do the caring work. They're more likely to leave the labor force when they have children. They're more likely to take a sick child to the doctor and therefore miss days of work. And research has shown that when men have a child, it tends to make them look better at work. And when women have a child, they're tended to see it as less of a desirable worker. So what happens in terms of childbearing and the decisions that go on at home have a lot of impact in terms of what goes on in the workplace. And that's, I think, way more sticky to get into, how couples make decisions about sharing work and sharing childcare and sharing, housework. Because what has tended to happen is while values have converge on the idea, at least in the US, that women should absolutely work and have access to the same kinds of jobs, the expectations for who does what at home have not kept up to the same degree. And so women have to balance, on average, and this is not sort of the case across the board, but on average, a lot more demanding kind of schedule at home and have to work their schedule around that. And that can impact their ability to get promoted, for example. If you know you have a job or promotion that's going to take you away from home a lot, how do you settle that score when you know you have kids where you're the primary one that has to care for them? So I've heard of literally female CEOs, and if you notice this, just anecdotally, I've noticed many of them either don't have kids or have delayed childbearing. And then they have the resources to basically have nannies and caretakers and stuff so that they can kind of give all of their. So I would say when we talk about gender inequality, we also have to think about what goes on in the home and how those duties are divided.
I'm curious too, just how important is transparency? You touched on it a little, Phil, but I'm just curious. Would any of you tell each other what your salaries were? Would you feel comfortable doing that? Not that I'm asking you to do it. I'm just curious. Would you do that? Is that something you would feel comfortable with? And how important is transparency? I know President Trump recently stopped a rule that would require companies to share their data about how much they're paying people by race and genders to show how they're getting paid. How important is something like this in this discussion about inequality? If people don't ever know what anyone else is bringing in, how important is that? Go ahead, Stephen, we'll start with you.
I think everyone's different on this. I've talked to so many people, and it really depends on how it's discussed in your family. I don't even know if it's within a neighborhood or a part of the world or part of the country. I think it has to do with within some families, it's a completely taboo subject to talk about money and talk about income. And in other families, the 5-year-old knows how much dad's salary is, knows how much mom is selling things for on Etsy, right? I don't know. I know I'm one of the more open types. I don't mind talking about it, and I wish there was more discussion of it because I feel like better information can give us better results.
Go ahead.
This is really interesting. Iceland has one of the lowest kind of gender gaps between men and women, and they recently instituted a program to actually get companies to sit down, and so isn't an individual decision, with all their salaries, and then by job decide, well, what is this job worth? Not who's in the job, but what is this job worth? and then match up what the people in the jobs are getting versus what the job is actually worth. So basically decide based on job title and job responsibilities what should be paid, because I think a lot of this is unconscious. A lot of this is unconscious. I don't think that people generally say, oh, I have a woman in front of me, I'm going to pay her 20% less or something. A lot of it is unconscious and built up with little decisions that then add up to less money for women. And so in Iceland, they're actually undertaking like an accounting way of figuring out which jobs should get what money, and then bringing people up or down. So what they did is they had customs inspectors who, many of them, as they got farther in their career, would want to, because if they were outside, it was cold. Iceland can get pretty cold. They would, as their career was winding down, they'd come inside. Well, they were doing a lot of the same work as some of the clerical staff, but they were getting paid way more. Well, the clerical staff tended to be women, and these customs inspectors were men. So what they essentially did is, we're not going to put put your salary down, but we're going to make you go back outside. If this is the job you have, then you must have the duties that are required. And if you're coming in and you're doing a different kind of job, then you shouldn't be getting paid that much more over the people. So they were basically making it an accounting, where they were really looking at the job and how much it's worth and not worrying about who's in it. And so something like that, I think, would be really hard in the United States, but I think really useful in that people would really have to think hard and not think about, oh, well, I'm going to pay this person less or whatever. The biases would be much harder to creep in.
I know Phil's excited to talk about Thomas Piketty. I don't know, I'm sure I pronounced that incorrectly, but I tried my best. He's a French economist who wrote the bestseller Capital in the 21st Century and explores inequality. And I'd like for you to just take a stab at explaining what his main thesis is, what is he saying, and what do you make of that?
Yeah, so I can give both my own take, then also try a synopsis of the book. My own take is he's a French economist that really likes taxes. And he comes up with an argument that's basically a century-long worldwide justification for raising taxes. It's probably not much more complex than that, although he does bring in various claims behind it. So he has kind of a core economic argument behind it, and this is, if you remember back when some of the publicity around the book came out, they kept quoting this formula, as R is greater than G. And what he was basically saying is the return on capital, the return on the capital stock will tend to outpace economic output or growth through other mechanisms over time. And he's basically arguing that if you have this type of a scenario and allow it to play out across an entire century, you get a world in which most wealth is acquired from rentiers that are basically riding on properties that they own, basically riding on inherited wealth and stock and interest returns, and they're going to outpace the rest of us. So that's the main mechanism of his theory. And he says that there are certain events across the 20th century that knocked down the capital stock. They knocked down the very elites of society, and some of them are pretty horrific events. So World War I and World War II are the big examples of that. And I don't think anyone in their right mind would espouse a world war as an inequality reduction policy. But nonetheless, it's one of the effects that he claims takes place. The one that he does actually like much more is tax policy. He views high tax rates as a mechanism to maybe you rein in the top 1%, you put extraordinarily high progressive taxation on them and redistribute it to the rest. So it's almost like a punitive wealth tax on people that fall into this rentier pattern. So that's the gist of his argument. What I do and when I study it, I look at some of the same trends century-long as discussed on how do you measure inequality, and I have suspicions on the robustness and the effectiveness of high income taxes at achieving the goal that he wants. And the main example I'd cite for you is the United States. We all know the income tax has changed quite a bit over time in the United States. I'll give you a statistic. So mid-1950s through about early 1960s, the top marginal income tax rate that the richest people in the United States paid. Let's take $1 million earner as a tax bracket. So now I've actually looked this up. You see the $1 million tax bracket on the statute books, on the law books of what it says they have to pay for their marginal rate. It's over 90%, 90, should go into income taxation. Now, how many millionaires in that category actually paid that rate? because there are all these deductions and exemptions and loopholes and ways that you can shift your wealth around, so we went through and found some of the data underlying of what they actually paid in their tax payments. So the statute book says 90%. The actual effective tax rate, and I think this is 1960 for a person that's making $1 million a year, is about 46%. So you basically have the tax rate, at least from the top marginal tax rate that's on the statute book, to what the effective rate that they're actually paying. So what we come up with when we look at these data on the performance of the tax system over time, his narrative kind of breaks down. He's emphasizing a period when the statute books are saying that the rich pay much higher taxes than they do today. But if we look at their actual tax rate that they're paying when we take into account all these other deductions and exemptions and loopholes, it's not far removed from what we have today. So the mechanism he's saying is driving inequality reduction really isn't there. It really isn't all that robust of a relationship. And if we go internationally, we look at other countries. This is one data analysis that I'm working on right now that I've performed. I took the top tax rate on the richest people, basically, for 120 countries. You can get this out of the World Bank. They have a mechanism that tracks this to the best data that they have. You can also look at estimates of how much of the income in that country is received by the top 10% of the society. And again, about 120 countries or so that you can get this. If you plot these two together, it just looks like a giant blob of data points. There's almost no relationship. There are some countries that have really high tax rates and relatively low inequality. There are some countries that have really low tax rates and relatively low inequality. And then vice versa. So it's the relationship that's posited here is kind of the mechanism behind Piketty's thesis. Even though he's quite fond of it, he always defaults to it. Well, we need to raise taxes on the wealthy to knock down inequality or stop it from reconstituting. The relationship there just isn't all that strong, and it isn't very well attested in data, including the U.S. data.
Does anyone else want to weigh in, Stephen?
I'm really just taking a point from Phil because I know about something that Phil has written that's not out yet. And there's another piece to this, which is it turns out the top 1% of earners, the top 1% in the income distribution, actually pays a larger share of the total tax revenue that the federal government gets when top marginal rates are lower, historically, over the 20th century. I don't know exactly why, but when the marginal rates are lower, something happens that leads to the top 1% actually paying a much larger chunk of the total tax revenue. As a matter of fact, the Piketty Says data series looks like an upside-down version of tax revenue paid by the top 1%. That when inequality, or excuse me, look, not upside down, it's right side up, right? Yeah. It's right side up. That when income inequality as measured was very low in the middle of the 20th century, that's when the top 1% was paying the smallest share of total tax revenue. And when it started to rise after in the 1980s, that's when they started paying a whole lot more and more and more and more. So it's interesting. And like Phil, data before up to 1943, I don't pay attention to or trust. He pays attention to it, but I don't trust it.
Yeah, I can jump in on a historical point here. You look at income taxes across, we've had income taxes in place for about 100 years. So 1913 is when the 16th Amendment is passed. And this is really my old stomping ground for historical research. I was researching the imposition of the income tax well before I got into the inequality game. But if you look at the tax system over time, prior to World War II, only the rich people paid income taxes. Like the top 10% of society paid income taxes. Everyone else, more or less tax-free, or you're paying indirect taxes from other things, like excise tax on the tobacco or the alcohol that you buy. That's how you paid the federal government. But only the rich paid the income tax. Something happened in World War II. To finance the war, the federal government expanded the income tax downward. So if you were making $10,000 a year in 1939, there's a good chance that you met enough exemptions you didn't have to pay the income tax. By 1941, you're on the books. You have to take money out of your paycheck to pay the income tax. And by 1943, they start doing something really interesting. They start deducting it from your payroll. They get your employer to do it, so it's automatic. You aren't self-reporting anymore. You can't evade it if you wanted to. It's self-enforced. This pattern takes place between, roughly 1941 and 1945, and the thing that happens, it's retained after the war. So the income tax system we have today is this post-World War II system that has moved the burden downward, and it moved it downward aggressively in the middle of the 20th century. So the supposed golden age, again, of low inequality in the 1950s and 1960s, what's really happening is you are soaking it to people that are in lower and middle income brackets. And what we've seen since 1980 is their tax rates have gone down at a faster rate than the wealthiest. So what this does is it shifts the burden of taxation back on to the top 10% or the top 20% today that now finance probably the majority, the vast majority, in fact, of the federal government. So it's kind of a movement almost back to what the tax regime used to be in the 1930s when only the rich people paid it. Yeah, you have lower incomes are eligible for income tax payment, but it's a much lower rate, much lower overall burden than they experienced at, say, 1950 or 1960. And I think that's actually a pretty extraordinary shift in policy. And I say if you are in a lower to middle income bracket, that is absolutely for the better to move away from this notion that you should put pile taxes upon people that are lower down the income chain. Move away from this notion that was adopted in the World War II era. Shift the burden back towards where it was historically on the wealthiest earners, but also keep the rates low enough that it's not punitive. Keep them sufficiently low that there isn't like this detrimental effect going on in the economy. Counterexample, France. So about 5 or 6 years ago, although I'm not sure if he'd still claim credit for it, Piketty was one of the main advisors to the French government that instituted this massive tax regime that was intentionally targeting the wealthiest earners in France, the highest earners in France. So if you were a multimillionaire in France, you were the head of an industry, head of a company, you just got slammed with these extraordinarily high punitive tax rates. What do you think happened? Well, they moved to London, or they moved to Russia, or some of them retired, some of them pulled out of business. It had this detrimental effect on economic productivity among the CEOs and highest earners of the country. So they end up effectively undermining not only their tax base, but their economic engine. And you start seeing companies following their CEOs, moving abroad. You start seeing an exodus from the economy. That's the risk here, is you want to hit the sweet spot that is well below that punitive level, but nonetheless can retain this progressivity that we see.
Did anyone else want to weigh in on that? I'm curious, what role does minimum wage play in wealth inequality in the U.S.? How would that impact job growth? Who wants to tackle that one?
All right. In terms of a technical answer, a high binding minimum wage. Binding simply means it's a minimum wage that's high enough to actually be higher than what most workers are earning. So, for example, during the 90s, when the federal minimum wage was very low, it was estimated that something like 2.5–3% of the labor force earned the minimum wage. It essentially wasn't binding. It was almost no one in the labor force aside from teenagers, people working very short part-time jobs who eventually moved out of those jobs were earning it. And it was such a small chunk anyway, even of them. So for a minimum wage to be binding, for it to actually have an impact and raise people's wages above what they would earn anyway, that's what it means for it to be binding. That also means, though, that it binds the market. That means that it creates a disequilibrium. It means that quantity demanded is going to be less than quantity supplied. It means there's going to be more workers willing to supply their labor at a higher wage and fewer employers willing to pay it. What would it mean for income inequality? It may well be that when you are looking at tax return data, that you're going to see a little improvement in inequality. Maybe, maybe not, because the way we measure it usually is we're measuring the top 1% and we're measuring the overall dispersion, but it may reduce inequality. But my guess is even in the data, it would be hard to pick that out. The real threat, though, is that it reduces employment opportunities at the bottom of the economic ladder. At the very bottom rung, for people who are really starting out and don't have work experience, they need a way to get work experience. And I've been, thinking, there's no doubt that there's a huge wage premium there, right? There's a huge salary premium on having a college degree, for example, even for having an associate's degree. But at the end of the day, what makes us productive and what leads to us earning more over our lives, that has so much to do with the experience we get. And we need those opportunities. We need those entry-level opportunities. One of the frustrating things that comes out of labor regulation, the minimum wage is just one example, but occupational licensing is another one, is that the entry level of work is taken away from a lot of people who simply can't afford to pay for the education they need or the license they need, or aren't able to produce $15 an hour worth of hamburgers today.
I want to ask, did you want to weigh in on that?
No.
Or anybody? Did anybody? It's okay if you do.
I'll throw in a quick historical note that kind of reinforces some of the problems with the statistics on whether they really capture all of inequality. If you go back into the 19-teens and 1920s, there are many recorded instances of people that were advocating the minimum wage for overtly segregationist, white supremacist reasons. What they basically said is that they said, well, black people are at the lowest income stratus of society, but they're also competition to poor white laborers. So if we pass a minimum wage coupled with segregation, what does that do? It squeezes the black labor force out of the market from competition. It means white laborers in the South get paid more. So it's a really complex, kind of a mixed history here. And I'm not saying that all minimum wage today is done for racist reasons, but I'm saying that there is a real danger here that we have to be aware of. And some of this rhetoric persists through the Civil Rights era. Through the 1960s, when right after they passed the Civil Rights Act, everyone thinks, okay, this is going to be great economic activity for black people. We've brought them into a state of legal equality where they're no longer penalized. Well, the next year, several southern white politicians start discussing, well, we should raise the minimum wage again. And there's kind of a wink nod going on there that this is our way that we undo what we just adopted with the Civil Rights Act.
Go ahead.
I guess this is more me thinking out loud, and back to the issue of taxes, which is we're concentrating on taxes on the wealthy, but what strikes me is that when we think about people being taxed in general and the middle class being taxed, it strikes me that we've gone so far in terms of valuing individualism that there's this lack of collective responsibility. So for example, my sense is that people basically want everything. They want these services for nothing. And there's a sense, if you want good schools, you need to pay for it. If you want paved roads, you need to pay for it. And it's not just about the wealthy paying in, but it's about everybody paying in for these things that are collectively beneficial. And it's fine if you don't want to pay it in, but then you don't get those good schools, you don't get... So this sense about taxes where people are so worked up about it. I mean, for example, I don't have children, but every time there's any levy for the school system, I'm like, yep, I'm paying that. And that means my property taxes go up. But from my standpoint, I want those kids in school. I don't want them running around the streets of my neighborhood with nothing to do. And so this sense of collective responsibility, at least for the American case, I think there's something missing there, that there's definitely we need to get to some equilibrium, where I certainly don't want to get to the point where you never worry about what you need, but only ever worrying about what you need seems to be bad for society in general. I mean, especially when you look at, for example, Colorado schools, where people are so upset that some of the schools aren't doing well and we don't really give that much to education.
With the way that our world is now, though, what is your prediction for 5 years from now? Is that possible that people will get away from self-concern and want to be more concerned about the rest of society?
Oh, can anybody else answer that?
Go ahead.
I don't know.
I can't answer. I'll just start my answer with that. But I do think there is a worry regarding how self-interested motives may crowd out other interested motives. So not only we have to be concerned about the fact that indeed values matter and how we construct our society and how we see ourselves will impact our policy decisions and choices, right? But not only that, but once we start fostering self-interested activities, which are not bad. I mean, if we're not self-interested, we're not going to like feed ourselves every day, right? So of course it's great that we are self-interested. But if we reinforce it too much, it may crowd out other types of motivations that may be important for social cooperation. Because while we do need to look after ourselves and to a great extent look after ourselves, we benefit everyone else in doing that. There is also a concern that we have to have regarding social norms, and that the overlooking of our self-interest that may blur this concern about social norms. And there is a lot of research. There are like some examples that are simpler, but one very paradigmatic example of how this self-interested motivation would crowd out social norms is this daycare in Israel, if I'm not mistaken. I don't know if anyone knows that they had this issue with parents picking up their kids late. And
I did hear about this.
yeah, and then they were like, okay, what can we do to fix this problem? And they thought, let's impose a fine, right? Because if you increase the cost side of the equation, it will make people less likely to do it. But what they overlooked was the fact that in addition to the standard cost-benefit calculation that we do when we make decisions, there is also a social norm that guides our decision-making. And the social norm is being late is bad, even if sometimes they can take advantage of it. We just have this norm. Imagine if we were always late. It would be really hard to meet, right? So what they did was they imposed this fine, and then what do you think happened? Instead of them being more on time, they were even later. Because it crowded out this idea, because they were late before, but they were also feeling bad about it, right? But once they started paying for it, well, now they were late and they were paying for it, and they were like, I paid for it. I'll leave my kid there for 3 extra hours and give you the money at the end of the day. So that's what happened. And the problem is that it's easier to crowd out this concern with norms, with social norms, than it's easier to bring them back. Once they're out, it's very hard to bring them back. And that's one worry that I have when you ask what will happen in 5 years from now. And you see that happening with kids very early on. They're very extrinsically motivated. And I don't know.
We have about 20 minutes left, so I wanted to make sure that everyone that raised their hand at the beginning that said they are familiar with economics, that you're able to ask
Or
your
not.
questions too. So is there anybody out there that has some questions that they would like to ask? And do these microphones work? If you guys want to come to the microphones, you can ask it so that everyone can hear you and it's recorded or on.
I think he's going to flip them on.
So what?
Oh, it's
This one? Faster. Yes.
There we go.
Ah,
There we
you
go. So earlier you were talking about the discrepancy that you noticed in India versus discrepancies that you notice here in America. How in India you pretty much have this line that was dividing slums from skyscrapers, and then in America it's not as visible. Do you think that the middle class as a whole plays a part in that? Is there a relationship? Do you think that because the middle class may be larger in America, there's sort of this hidden in plain sight kind of thing happening where the poverty isn't as apparent because there's so many different levels, gradients of income?
That's an excellent question. I hadn't thought about it in terms of the middle class. And your question makes me immediately think, well, what's going on in India is that you actually have an emerging and growing middle class. And what a lot of people in the U.S. would say is they would say the middle class is shrinking. I don't know if you can statistically back that up, because defining the middle class is kind of, you're looking at the income distribution, you're looking at the middle, and the middle is the same kind of, right? It still looks a lot like a normal distribution. But we probably don't think in terms of the middle class growing in the U.S. We think a lot of people are kind of moving from middle class to upper middle class and upper middle class to maybe even beyond that. So, you know, the steady state, it's just an interesting question. Is it because there's such a large middle class in the U.S. already? That may be the answer. It may be that if you were to go to New York in 1840 and take photos, you could take photos that present this stark contrast, right, between rich and poor. So there's something to that maybe it's part of the process of economic development. But incomes per capita in India are already way above 1840 U.S., right? I mean, in real terms. So I think that's part of it. I think the other thing that's going on, I think it is just a difference in quality and texture and what inequality means in the U.S. The thing about the U.S. is, it can't be true, but as far as I can tell, everyone I've ever talked to thinks they're middle class. They think they're middle class. I think I'm middle class. And you just, and people who make half as much as someone else are driving literally the same make and model of car and living in the same neighborhood. I don't know how they do it sometimes, right? But it happens. Maybe they're more frugal elsewhere, or right? And it's just it's very tough to see. So I think yes, I think it does have something to do with there's an established middle class in the U.S. I think that makes it harder to see. But I think the other thing that makes it harder to see is the way people live their lives is similar in a meaningful way. I mean, I appreciate your comment about, you know, the super rich kind of, or people isolating themselves off in gated communities and things like that. But at the end of the day, you still go to Ruby Tuesday together, right? Do you know what I mean? Right? I mean, unless we're way up there. I understand there are people who don't eat at Ruby Tuesday. I guess that's their loss, right? You know, where that's not good enough for them. But, right? What I'm saying is there's so much going on among the 99%. It's really hard to see with your eyes big gaps in distribution.
And just to piggyback on what you said, it's almost un-American to say you're not middle class. Do you know what I mean? So everybody's middle class, and to say you're anything other seems somewhat wrong. So that goes into a whole other discussion of this discomfort that Americans have with class differences, which are absolutely there. In other countries, people discuss them openly. In the UK, it's people know what class they're from. They have accents that differentiate them, and there's that kind of, okay, I don't want to get all marks on you, but like class consciousness of kind of this is where I am, and that's a group, and we have different interests, that it's un-American to say those things. And so having a real discussion of class and who is actually in the middle class and who may not be and what does that mean, I think it's really hard to have that, because nobody is anything other than middle class.
Go ahead, if you have a question.
First of all, I just want to thank you guys for coming. This was incredibly enlightening. I'm going to try to make this not such a long-winded question, but so a common thread throughout this discussion was that incentives matter, right? And you guys mentioned that what you measure, what we go out of our way to find out about, goes a long way in saying what we care about. And so I'm wondering if our focus on income is a function of our being a consumerist country, and if we're maybe taking struggling or suffering out of context and making it a value term as opposed to it being, I don't know. I used to be an ardent Buddhist, and Buddhists tend to look at suffering. Obviously there's a middle way, but suffering isn't innately bad. Suffering builds character. That's just how it is. And so I guess if we more shifted focus to I don't know, different measures of quality of life, would income inequality be as big of a deal?
Try and tackle this, I guess in the statistical question, money's easy to measure compared to other things. So that does tend to rise to the top. If you want to have an empirical assessment of inequality, even if we are very poor at coming up with that assessment, having dollar amounts figured in there, that there's just kind of a bias in the way that it's researched. But your point's taken, and I think very prominent in history. I want to give you an example. In the 1920s, President of the United States, Calvin Coolidge, his son was playing tennis on the White House tennis court, cut his foot open one day, caught a bacterial strain from stubbing his toe basically on the tennis court of the White House. Think about it. This is the most powerful person in the world at the time. The kid is dead 2 weeks later from blood poisoning, from a common bacterial infection. This is mid-1920s, so the age of your grandparents, people that we know or that we knew in our lifetime were alive, could not have access, the richest, most powerful people in the world could not have access to what we would take for granted as like an afternoon trip to the doctor's office or an afternoon trip to the CVS pharmacy, because they didn't have penicillin back then. Even more extreme example, you go back 300 years. Go back to the 1700s. Queen Anne of England, again, arguably the most powerful, richest, wealthiest person in the world for her own time. She spent the entirety of her reign on the throne basically trying to get pregnant to produce an heir. And they kept either dying in infancy, some were stillborn. The ones that made it past infancy, and there was one child, one prince that made it past infancy. He gets wiped out in the great smallpox epidemic of 1690, whatever. It obliterates the entire line to the English throne. So the most powerful person in the world is living a less well-off life than you or I or almost anyone we'd encounter on the street. How do you measure that? How do you measure that type of well-being? That's contextual to my own time. That's something that I experience. I don't have a number that says, well, I have X number of penicillin that I have access to. I have a vaccine against smallpox or these other horrible diseases that I'm going to fill. But I know that change is material. I know it's realized. I know it makes an impact on my life. We no longer have Spanish influenza epidemics that wipe out 50 million people. This is in the 19-teens, again. So in the lifetime of people that we all knew. Just look at that point of comparison across time. Maybe that's our better indicator than trying to add up like wealth or add up how income stacks up between different groups of people or different people. Let's look at the well-being of the least well-off person in society, and just technology alone, medicine alone, availability of food alone, the fact that we have electricity and lights and comfort. It can be freezing outside, but we can be inside and have an HVAC system. That makes my life a lot better than someone who was living in a medieval castle that is hit by the freeze and you're stuck huddling around a fireplace for 3 days. So how do you measure that? I don't know, but I do know that there is a point of comparison that is absolutely better off today.
I think Daniela and then Jasemia had something that each wanted to say.
So yeah, that's right. And it's amazing when we think back to the examples in history and the fruits of development that we overlook in our daily lives are pervasive. So there's that, and I think that's really important. And I also think because of that, so the reason why we are discussing, which one is the best measurement, right? How should we do that? Is because we're all like well-fed in a very comfortable environment, because otherwise we wouldn't be talking about that. Right? We would be worrying about something else. So that's something that we should not lose sight of. We should keep that perspective that we have really created all these things that are really wonderful and amazing that we did that. But as humans, right, we don't just stop and okay, good, got it, right? We don't do that. And to your point, I think we use income as the basic measurement. One of the biggest benefits of it is that it is a simple, with all the complications, it's still simple when you try to measure other things, right? It's easy to understand. When you start trying to use other measurements such as the Human Development Index, developed by Amartya Sen and others based on the capabilities approach. So he has this whole idea that we ought to measure other dimensions of well-being and not focus on income in and of itself. And I think that there is a lot of credit to that. But and then you come up with a number. Well, it's a number that it's income, health, and education. Like, it's hard to know what it means, right? You know that the higher, like, the better, the lower, right? You have, like, those parameters, but it's not as straightforward as an amount in dollars. That's really easy to understand. But I do worry about the fact that there is this cycle, kind of this feedback loop between the fact that what we measure reflect what we value, but what we measure determines what we value. And I think we ought to keep that in mind. Because one thing is to see, okay, we'll see income as a means to everything. So the idea is that I can transform $1 into whatever I want. So it's a value-free measurement. It has all these qualities, and then it makes sense to use it. And then we think, okay, that's good. It reflects this view that we can each pursue whatever makes sense in our own lives, and right, good. But then once we start only using that, well, now we start only caring about the money because we only care about that indicator, right? And that's the worry, and then that's when we have to broaden our understanding of what it means to have a good life, because we care about the economy, at least from my perspective, and that's something that I always like to emphasize, not because we care about this paper, or this piece of paper, or because we care about this number. It's because we care about how people live their lives. We care about people not getting sick. We care about people being able to thrive and to fulfill their potentials in whichever way they want to. And the over-reliance on money may get us out of that, right? So I see your worry there.
I just want to let everyone know we've got about 10 minutes left. I know Jasemia wanted to weigh in on this.
Oh, then I'll be quick. Hi, Kelly. We all know that one measure can't capture everything. So whenever you only use one measure, it's always going to necessarily leave something out. But one study that made a big splash recently was that study that basically showed that after, $75,000, there's diminishing returns. Like your assessment of your happiness doesn't change at all with more money. And I think that that's something important to think about, that money matters, but I think it matters up to a point, and that there are other measures of well-being that are important. They're just hard to get at, and they're hard to agree on, and they're hard to put into an index. So there's a lot of data measurement issues. But I do think it would be useful to think about, particularly in a culture that emphasizes consumption so much, in what case does consumption not get you what you need, or maybe detrimental? Anyway, if people have had that sense of, like, you look at magazines and you look at advertisements and you're like all of a sudden unhappy with everything you have, and you must go out and buy the new next thing because you're not a good person until you have that. I mean, there's something to be said for thinking about, well, what actually brings you well-being, and that might not be all those things that we sometimes emphasize, and we might de-emphasize things that actually matter. So.
We've got a question on this side, and then we'll go back to that side. Go ahead.
Hi. Hello. Is that working?
I think it's on.
Thank you to the panel. I've learned a lot today. I'm not an economist, and so my question might seem a little odd. We started by talking about different ways to measure inequality in society. And it was very interesting to me when we started talking about tax rates. That got tied to income inequality. And there was nothing in that discussion about what we actually did with the tax revenue that would address other types of inequality. So not being an economist, again, I know you have limited time here, but that seems very similar to what I hear in the media and political discussions when we talk about tax rates. What happens to this is what we're collecting, and this is how we spend it, and this is the benefit or the detriment to society outside of income inequality?
That's an easy
Yeah,
one.
I guess. Well, there's a reason we have a $20 trillion national debt, and this has been a century-long pattern of disassociating revenue from what we actually spend and what goes out. I think that's actually unfortunate. I think if you look back to previous periods in history when we were less tolerant of taking on so much debt, the two were much more connected. They would adjust revenue based, they'd adjust taxes to bring in revenue based on what they expected that they were going to spend with the government. The fact that we have a high tolerance for deficits, and it's a perpetual tolerance for deficits, has been for decades. Even in times of extreme prosperity, even in times of economic boom, we do not pay down the debt. Instead, we just pay more and more and more. What does this mean about our spending priorities? Just one thing I'll note, we were talking at a little bit over dinner last night. If you look across the United States and ask the question, what are the richest counties in America? Where are they located? Does anyone have any idea? Well, there's a cluster of them, and they're all clustered around one specific city, and that is Washington, D.C. So you have the richest counties of America. There's like 4 or 5 of them there just encircling the capital. Why is that? Why is that? Coincidence, pure coincidence. Well, I think there's actually another layer of inequality here, and this is how the disbursement of the cronyism, the disbursement of the favors of government tends to be passed out. It's proximity to politicians. It's I have a cousin who is a relative of a congressman. He got me the special favorite deal with the U.S. government to my firm that I otherwise wouldn't get out on the open competition of a private sector market. I do think that's a problem. That goes back to the question of what do you see as something looming as an issue for 5 years or 10 years from now? The fact that we are not addressing that very robustly. We are not paying much attention to the effect of government spending itself as a fostering device of some of these types and layers of inequality becomes quite the problem, and it also compounds everything that we know about the debt. It also compounds everything we know about excessive spending.
Did you want to quickly answer that
Yeah,
too,
just to
Stephen?
tack on to Phil's point, I mean, so there are severe asymmetries in how the revenues are distributed, and the economists who've studied this, you know, it looks like the large chunk of federal revenue that's being distributed, often with the intention of going to address maybe income inequality. It's a smaller chunk than you might think that actually goes to direct aid. One policy that might improve that would be, rather than focusing on a minimum wage or focusing on certain other types of benefits, would be some sort of expansion of an earned income tax credit, which is a watered-down version or a more technically oriented version of what people seem to be talking a lot about now, which is a universal basic income. Instead of having a universal basic income where I get $20,000 even if I earn more than that, right? But make some floor and work and make that work through the tax policy. That is far preferable to trying to interfere within labor markets. That just makes sure that you are setting some sort of minimum standard of living within the country, if that's your goal. But yeah, the whole question of taxes being separated from or with no discussion of tax revenue, that's because it's very interesting. It seems like almost no matter what U.S. federal tax policy has been, tax revenues have been around 20% of GDP, very stably for decades and decades and decades. Whether it's 1959 or whenever it was that the top marginal rate on income was 90%, or in 1987 when the top marginal rate was 35%, federal tax revenues were still around 20% of GDP. The bigger the economy is, the more tax revenue they get. In recessions, they get a lot less, right? And it's just very sensitive to the overall size of the economy, but not so sensitive, surprisingly, to changes in tax code. What is sensitive to changes in tax code is how people at the top 1% behave and what they count as personal income.
Quick lightning round. See if we can get these last two in the last 3 minutes.
Good afternoon. Thanks for being here. I have a question. My question is, do the government in general around the world, because the United States is an exception, work to eliminate the poverty, or they want to keep it in a specific level so they can use these poor people as a worker in entry-level jobs and stuff like that? And when the market increases, like the demand for the job, in the next step or in the next level, like the demand increase, they will let those people move to the second step And as you guys mentioned, that sometimes they put some restriction on these people, like they have to pay a lot of tuition for their schools or something like that. So when the demand increase in the second level, they will make it easier for these people on the first level to move up to the second level. Thank you.
Who wants to tackle that one?
Well, I don't know about the data, but Marx had this idea of the reserve army of the unemployed, where he basically argued that societies have an interest in keeping a certain amount of people on the lower rung as a way to keep other workers in line, and essentially to benefit certain groups. So this is not a new idea. I don't know to what extent there's any kind of data to back that up. I don't know of any. Do you guys know of any?
Actually, United States is exception because there is immigrant, there is refugees, and there is restriction on these people, like to work for 5 years till they get their citizenship. Then they can apply for a specific kind of jobs. But let's say other countries, like very individual countries such as North Korea or Iran or all these countries, they don't have an external workers or something like that. So if they let all these people go to the second level or third level, who's going to work on the inter level? Thank you.
I think it's rare that it's deliberate to keep the masses poor. It has happened, so I think apartheid is definitely an example of that, right? And there are similar examples throughout history, but it's somewhat rare. It's somewhat rare in today's world for sure. Even North Korea, I would say, I don't think they're trying to keep people poor. I think they just have no idea how to make them better off.
I need to quickly let everyone know it's 1 o'clock. I don't know if you guys have a minute to answer the final question here, but I understand if you got other obligations. But go ahead.
I'll make it quick. I'm Aaron Goldschmidt, by the way. I'm an MBA student here at Metro. I'm from Chicago, Illinois, which is one of the most segregated cities in the country. We've always had problems with inequality, poverty, and a lot of violence. I believe it's all related to education at some point. Mayor Rahm Emanuel continues to close schools and fire teachers recently. So my question is, how do you put a stop to politicians who are putting education on the back burner instead of trying to bridge the gap between income inequality through education?
It's a tricky one.
So my understanding is that in societies where well, maybe this goes more towards college, but if young people don't vote, politicians have no need to worry about their needs. Why is Social Security the third rail of American politics? Because seniors vote, because they care about Social Security, and they will vote somebody out or vote somebody in that works towards their interests. So I think to some extent, education generally isn't as much of a priority because young people just don't vote. They don't vote, they don't worry about, and so politicians don't have to listen to them. But I was interested in your, well, does anybody else? I don't want to. No, you can. Okay. Yeah. Interested in your mentioning of Chicago and being really segregated because I thought somebody was going to ask me what we should do about inequality. And one of the things I was going to bring up is basically residential segregation tends to amplify inequalities because it then ends up being something that affects your economic opportunities, the jobs that you're available to, where geographically you are in the city, what amenities you get, and what schools you go to. So I think in terms of education more generally, that we need, I think we need a better way to fund education that isn't based around property taxes in the neighborhood where you live. Because we have very unequal schools that tend to reproduce inequality as you go up through them. And so that's what I would say in terms of schools. I don't know what we do about the politicians per se, but in terms of the schools themselves, I think we need to really rethink how we fund education because rather than education being an equalizer, it actually tends to reproduce inequalities.
Well, thank you all for coming. Thank you to all of the panelists. What wonderful conversation, and I learned a lot. I hope all of you guys did too. So I'd love to give them a round of applause and say thank you for being here. And I hope you guys all enjoy the rest of your day out there in the cold.